Hey guys, welcome back to another video. In this video, I'm going to be talking about McDonald's, and as we can see over the last year, McDonald's is up about 9%. They're underperforming the market, which is up 21%. But McDonald's is an interesting one because this company is actually very successful and they make money pretty interestingly. They have an interesting business model, contrary to popular belief. So I'm going to talk about it, and then I'm also going to look into their financial statements to get a better understanding of the financial health of their company. And then I'm also going to value their company using a discounted cash flow model. So to talk about their business model, McDonald's is obviously the most valuable fast food restaurant chain in the world. McDonald's makes money by using its fast food products as a leverage to lease real estate to franchisees. That's their main business model. They don't actually really make that much money selling hamburgers. They mainly are a real estate company, and they make money by leasing real estate to franchisees. In fact, about 93% of McDonald's locations worldwide are franchises. Being a McDonald's franchisee is almost a guaranteed moneymaker because of the impressive profit margins from selling McDonald's fast food, making it a very attractive opportunity for investors and also a very easy sell for McDonald's. There are currently about 38,000 McDonald's locations worldwide, selling 75 burgers per second to 68 million customers per day in 118 countries. That's the equivalent of approximately 1% of the human population per day. The advantage of the rent and royalty revenue stream that comes from McDonald's real estate franchise business model is that it is very stable and predictable. McDonald's is able to negotiate favorable deals because of their low operating costs, high profitability, and control over the land and long-term leases. The franchise model is basically a subscription-based revenue model where the subscriber, aka the franchisee, pays a fixed amount each month to McDonald's for owning a location. Franchisees are responsible for paying salaries, ordering supplies, and paying the rent or mortgage for the location. Hence why McDonald's operating expenses are so low, because they basically pass all of those operating expenses off to the franchisee. The initial franchise fee for an investor to open a franchise location with McDonald's is about $45,000, and the monthly service fee is typically equal to about 4% of gross sales. Because of this, McDonald's keeps about 82% of the profit generated by franchisees. Although most of the revenue for McDonald's comes from their company-owned stores, most of the profits come from their franchise locations. And this is because of the fact that there are high operating costs associated with owning a store. But if McDonald's franchises a store, they pay almost nothing in operating expenses while still being able to collect stable cash profits from their franchisees. This news might make it sound like franchise owners get nothing, but this isn't true. Franchise owners are almost guaranteed to make money due to the high profit margins from selling the fast food. On average, McDonald's franchise owners in the US generally make more than $150,000 in profits per year. So it's a really easy sell for McDonald's because you're pretty much guaranteed to make money if you open a McDonald's franchise. And then it's also in McDonald's best interest because they don't have to spend any money on operating expenses, and they can just sit back and collect franchise fees from all of their near 38,000 franchise restaurants. So now I want to talk about McDonald's financial statements. As we can see right here, this is their income statement for the third quarter of 2023. We can see they had a revenue of about $6.7 billion, which is up 14% from $5.8 billion year over year. And they had net income of about $2.3 billion, which is up 17% from about $2 billion year over year. For their fourth quarter, as we can see right here, they had revenue of about $6.4 billion, up 8% from $5.9 billion, and then net income of about $2 billion, up 7% from $1.9 billion. If we look at the full year results, it actually gets even more impressive if I scroll down here to their full year results. They had $25 billion of revenue in 2023, up 10% from $23 billion in 2022. But then for net income, they had $8.4 billion, which is up about 37% from $6 billion in 2022. A pretty massive increase in earnings growth. You typically see earnings growth that high with like tech companies or something. So seeing it with a restaurant chain like McDonald's, or more accurately, a real estate company like McDonald's, is obviously very impressive. And it doesn't really look like McDonald's has anything in their way to slow them down from continuing to grow and increase the amount of locations they have. We can also see right here they had total assets of about $56 billion and then total shareholders equity of negative $4.7 billion. Whenever I make a video about McDonald's, I always get asked, what does it mean when a company has negative equity? It basically means that the company has more liabilities than assets. In other words, they are over leveraged. So if they try to liquidate all of their assets right now, they would not have enough cash to cover the amount of debt that they currently owe to debtors and banks. McDonald's in this case is probably over leveraged because of the fact that they are a real estate company. And if anybody knows anything about real estate, when you invest in real estate, you typically take out a mortgage in order to own the location, and then you put a tenant in your property, and the tenant pays rent, and then the rent pays the mortgage. So even though it looks like McDonald's is over leveraged here and they can't cover their current liabilities, the fact that their franchise model is so profitable, they are basically anticipating that the franchise fees that they're collecting from their franchises, from their franchise owners, is going to be able to cover the liabilities that they currently have, which is actually probably not a half bad assumption to make, because that's usually how real estate investing works. Unless, of course, there's some sort of gigantic real estate market crash, which would not be that good for McDonald's. Then right here, we can see operating cash flow of about $9.6 billion in 2023. And then for their financing activities, we can see they had treasury stock purchases of $3 billion and common stock dividends of $4.5 billion. They repurchased about returned about $7.5 billion of cash to shareholders. So after you subtract capital expenditures from their operating cash flow, you get free cash flow of about $7.3 billion. So they basically returned all of their free cash flow back to shareholders through dividends and repurchases of common stock, which is definitely a good sign for shareholders. Now I want to try to value McDonald's company. Unfortunately, I was not able to use a DCF model for McDonald's because a DCF model relies on the equity and debt proportion of their balance sheet. And I typically use the book value for that metric because valuing a company's equity using a market value is kind of difficult. So given that they have a negative book value of equity, I can't really use the DCF model because I can't calculate a weighted average cost of capital. So instead, I decided to use a relative valuation model comparing McDonald's to other companies in their industry. We can see right here, I'm comparing them to Yum Brands, which owns KFC and Taco Bell, comparing them to Chipotle and also Starbucks. It looks like the average PE ratio for this industry comes out to be about 33 times earnings. Average price to sales ratio is about 5, and average price to book value ratio is about 6. So if you take McDonald's earnings and multiply it by the average price to earnings ratio, you get an intrinsic value per share of about $392 per share. And if you use that similar calculation for price to sales and also price to book value, you can see price to book value is pretty low, so it probably wouldn't be smart to use that one. But then also price to sales is about near same as about price to earnings. So we can see based on these values that McDonald's would be trading below their intrinsic value per share, since they're currently trading at $287 per share. And it looks like they have an estimated intrinsic value of $330 to $390 per share based on this relative valuation model. There's obviously a lot of assumptions happening here, so I definitely encourage everyone to do your own due diligence. Then over here, I compared them to their competitors based on profit margins and dividend yield. We can see McDonald's has the best profit margins out of any of the other two companies on this list, and they also pay the highest dividend. So by far on this list, first place goes to McDonald's. Lastly, I wanted to compare McDonald's to some of the other companies we've looked at in past videos. At the moment, I'm not going to include McDonald's on this list because every company on this list was compared to their intrinsic value per share from the DCF model. So I don't think it would be a very fair comparison to compare them since I used different valuation models. So I'm not going to include McDonald's on this list, but you can see the companies so far that were trading at a pretty good price compared to their estimated intrinsic value per share. And then if we see on the right hand side here for growth rate, McDonald's had an estimated growth rate of about 4%, as we can see right here, based on their growth rate and their free cash flow for the last 5 years, which isn't good enough to get them onto the growth rate table. But for dividend yield, they come in 10th place with a 2.1% dividend yield. So that's obviously good news for McDonald's, especially considering that a lot of the companies on this list that pay out a high dividend don't usually have good stock market returns, but McDonald's has both. They have good stock growth and then they also have a good dividend yield. So that's definitely good news. Then we can see right here for gross profit, McDonald's had gross profit of 55%, which isn't good enough to get them onto this list. But for net profit, came out to 33%, which puts them in 4th place. Definitely very impressive for McDonald's. And then for year-over-year revenue and earnings growth for Q3, they had 14% and 17% for earnings. Gets them onto both tables here, which is very impressive. We can also see that they got into both tables in the second quarter, and it looks like they might end up on both tables in the fourth quarter. So based on this, it looks like compared to other companies, McDonald's has pretty impressive revenue and earnings growth quarter to quarter compared to a lot of the other companies we've looked at, which is another good sign for McDonald's compared to other companies we've looked at. Then lastly, for stock performance over the last 5 years, McDonald's is up about 64%, which is not good enough to get them onto this table. Tesla had the highest at 850%. So let me know in the comment section down below what you guys think of McDonald's. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.